I'm Alicia Barry. Welcome to Close of Business. All that glitters is gold for investors. The precious metal smashing through the $4,000 barrier this week. The gold price has piled on 50% in the past year, on track to become Australia's second most valuable export behind iron ore. Driving the frenzy is uncertainty, including the risk of recession in the world's biggest economy. Nasim Karem has been investigating.
At this family-owned jeweller, demand for gold is dazzling.
People are rushing to buy their jewellery. They rather get the jewellery that they're gonna need in next year in advance to be able to buy it with a more cost-effective price. These are made in Australia.
Amir says in uncertain times, consumers see gold as a safe haven.
People are getting aware of where is gold going, which direction it's going, and they don't want to miss out.
The price of gold has risen more than 50% in the past 12 months to almost $4,000 an ounce. UBS forecasts it will reach $4,200 by the end of the year and stay there for most of 2026. Analysts say global factors, including the US government shutdown and risk of recession in the world's biggest economy, are driving the gold price higher.
Gold is an excellent hedge against inflation. It's also a hedge against uncertainty. Another reason, interest rate cuts are always supportive of gold because it doesn't pay a dividend, it doesn't pay interest. Finally, central banks are buying
as they look to diversify away from US assets.
There's a huge amount of central bank buying that has been driving the price higher. So you've got this extraordinary global scenario where risk assets have run very hard, but geopolitical risk is high.
At Perth Mint, demand for gold isn't just being driven by central banks. In the past fortnight, there's been 7,500 customers queuing a week, many lining up to buy gold bars.
On a daily basis, we're having to close the queues around 3:30 p.m. so that we can cater for the volume of people that are coming through to buy gold or to sell their old jewellery.
Gold is set to overtake LNG to become Australia's second most valuable export after iron ore.
Production of gold is expected to increase. That's one element to it, but also, more importantly, the price is expected to be stronger and stay strong.
Global demand for gold jewellery fell in the year to June, according to government figures. It's gold bars and coins that's driving the boom, with investors also turning to exchange-traded funds to get exposure to this precious metal.
We've seen something like a tripling of exposure to those kinds of ETFs over 12 months. We have not seen a tripling of any exposure to many other things over the last 12 months.
But Amir's worried that at some point the price could tank.
The price of gold is going up so fast, and if it crashes at some point, it would be hard to recover from that crash. So I would rather have a more stable market.
For a commodity that's been a staple of the global trading system.
And punter confidence in gold was on display in Sydney's financial district. Long queues snaked through the streets as investors waited patiently to take home a physical piece of the precious metal. Gold watchers say the flight to safety is a vote of no confidence in the chaotic economic policies coming out of the White House. Independent economist Saul Eslake joined me. Saul Eslake, welcome to Close of Business.
Thank you for having me.
So it's not just the decorators in the White House clamouring for gold. Investors are literally lining the streets. What is this telling us about the mindset of investors?
Well, it's clear that fear of missing out is a motivation for, in particular, retail investors. It probably has been for some professional investors as well. Sadly, history, going back at least to the stock market debacle of the late 1920s, tells us that when retail investors are panicking about missing out, the top could well be within reach.
Some analysts say this particular flight to safety is a direct vote of no confidence in Donald Trump's economic policy. What do you think?
I think there's a great deal of truth in that. One of the many ways in which the Trump regime is trashing America's brand is in eroding the confidence that investors and central banks around the world have long held in the US bond markets and the US dollar as a safe haven in times of uncertainty, even if, as during the global financial crisis, the US has been the principal source of that uncertainty. We've seen US bond yields go down and the US dollar go up as people from around the world have sought to buy US government bonds and hence US dollars in order to protect themselves from the great unknowns. But on this particular occasion, the response of much of the investment community, while it's been to buy stocks in the US that are at new record highs, has been to sell US bonds and to mark the US dollar down. The US dollar has fallen by more than 10% since President Trump was inaugurated at the end of January against an index of the world's other major currencies. Against some of them, it's fallen by more than that. And gold is one of the very few alternatives as a safe haven, along with the Swiss franc. And so in that context, it is very clear, I think, that investors have been looking to gold rather than the US dollar as a safe haven. Mind you, this is something that's been going on for quite some time before President Trump returned to the White House.
The American economist Paul Krugman has said under this administration, many previously inconceivable possibilities are now quite conceivable given the Trump administration's radicalism, like runaway inflation hidden by rigged official statistics. Do you see that as a possibility?
Well, you couldn't rule out the possibility, given, for example, that Trump sacked the head of the Bureau of Labour Statistics for producing figures that he didn't like, and has been moving to appoint people to positions like the Bureau of Labour Statistics and the Federal Reserve based solely on their personal fealty to him rather than to their competence. So that sort of thing can't be excluded. It has happened in other autocracies, but there's no evidence that it is happening as yet. I think the greatest concern that investors have, and it is one of the factors that's led to the erosion of the safe haven status of the US dollar so far this year, is the risk that President Trump could undermine the independence of the US's central bank, the Federal Reserve. His effort to fire Governor Lisa Cook on what are now clearly spurious allegations of mortgage fraud were, if enabled by the Supreme Court when it decides this matter towards the end of January, was a blatant attempt, I think, to gain a majority of Trump supporters on the board of the Federal Reserve based in Washington, which, if it were accomplished before the end of January, would in turn enable a Trump-dominated Federal Reserve board to veto the appointments of regional Fed presidents who make up a substantial proportion of the Federal Open Market Committee that sets interest rates. I think investors have seen that as an attempt on the part of the administration to force the Fed to do what Trump has been trying through juvenile personal insults to get Jerome Powell to do of his own volition, which is aggressively to cut US interest rates.
And just very briefly, Saul, back onto the gold price. Goldman Sachs is tipping it could hit $5,000 an ounce by December 2026. What's your view about where the gold price could go? Do you have one?
Well, I've always thought that trying to forecast the gold price is a mug's game, given the difficulty in determining what actually drives the gold price, let alone where it might drive it to suggest that the gold price would get to $5,000 would have seemed fanciful as 6 to 12 months ago. But given that it's now over $4,000 and that there is a very clear risk that President Trump will succeed in stacking the US Federal Reserve Board and thus, as I said, undermining international confidence in the US financial system and the US dollar's role as a safe haven, while I wouldn't necessarily predict $5,000 myself, you couldn't rule out that possibility.
Saul Eslake, thank you so much.
It's a pleasure. Thank you for having me, Alicia.
Paying off a mortgage into your 70s, that's becoming the new reality for a rising number of people. Fears are growing that the unrelenting rise in property prices is pushing borrowers into mortgages that will stretch well into their retirement. And as David Taylor reports, analysts are concerned many of them will run out of savings to fund their dream home.
The Australian dream is getting further and further out of reach. For those lucky enough to own their own home, like Nicola Dorborn, the challenge is paying it off before retirement.
Look, I haven't got a huge amount of super, so I really was trying to avoid that scenario.
The 59-year-old's decided to pack up and move, taking on a new home loan with her son and his wife.
I've actually found a house online and showed it to them and said, would you consider living in this? And they said, well, yeah, but we can't afford it. And I said, well, what if you could?
Property researcher Kate Brown says Nicola's dilemma is becoming increasingly common.
It's divide and conquer. We're looking at enormous debt now for one or two people to carry.
And the higher property prices go, the longer it's taking many Australians to get over the line for a home loan.
People staying at school longer than university and starting their career later and getting married later. But of course it also partly affects poor affordability. It's taking a lot longer to save for a deposit.
Hey, how you going there today?
Mortgage brokers are also seeing more midlife home borrowers.
We have a lot of clients that are over the age of 40 that we assist with when it comes to obtaining loans or finance, definitely.
But Daniel Lagden says many of his customers have repayment plans worked out.
I think when speaking to most of these people, their goal is that they plan to sell off the home or downsize the property so that when they go into retirement, they're not left with a mortgage.
Economists warn as Australians increasingly take out loans later in life, financing retirement will become more challenging. Mortgage brokers say non-bank lenders are taking advantage of this.
So a lot of the majors now aren't offering that 40-year loan term, but we are starting to see a bit of a trend of lenders coming through, what we refer to as non-banks, that are doing these 40-year loan terms.
I don't think we're going to stop seeing people who are in their 40s and early 50s looking to enter the property market, whether it's on their own after a divorce or on their own, because it's taking that long to be able to get that deposit and feel settled. This is not going to go away. We're an ageing population with a rising property market.
Nicola's hoping her finance strategy will see her retire sooner rather than later.
It's like a little beacon of light, really.
A glimmer of hope in a desperately challenging housing market.
The Reserve Bank governor has denied record low rates during COVID lit the fuse on the overheated property market. Green Senator Nick McKim asked Michele Bullock if she accepted that cutting interest rates to record lows during the pandemic played a role in pushing up home values. Mr McKim referred to former RBA Governor Philip Lowe's admission the central bank did too much in the pandemic.
I would not accept that the Reserve Bank is responsible for the housing price issues in this country.
You don't accept you played any role whatsoever in the housing price spike of the last 5 years? Is that your...
The housing, as I said, what happens with monetary policy as part of the transmission mechanism is through the housing market. We know that. But again, the problem is the lack of supply relative to demand.
National home values have climbed more than 50% since January 2020, according to data from property research firm Cotality. Australia's biggest manufacturers have warned the nation's broken East Coast gas market could cost thousands of jobs and derail the government's future Made in Australia policy. BlueScope Steel boss Mark Vasella says Australia is at risk of industrial decline. But energy analysts say Australia is awash with gas and a reservation policy is essential. Brianna Whitton reports.
Manufacturers like this are becoming a dying breed, and the sector says high gas prices are to blame.
5 years ago we were paying about $5 to $6 a gigajoule for gas. We're now paying around $15.
The boss of this aluminium maker says it's becoming increasingly difficult to pass on those costs to customers.
Our single biggest competitor is imports, and we are starting to lose market share in that regard.
Several major manufacturers have shut down, including Australia's only architectural glass maker, Oceania Glass.
It's just a crying shame that an industry that had been around for nearly 100 years has had to shut down, partly because of high gas prices.
Now the boss of BlueScope Steel warns Australia risks repeating the United Kingdom's industrial decline if the federal government fails to fix the broken gas market.
Australian manufacturing is at a dangerous crossroad. Despite massive gas reserves in Australia, one of the highest wholesale prices is here amongst producer nations.
In the past decade, gas prices have tripled. Mr Vasella and lobby group Manufacturing Australia are calling for a gas reservation policy and a mechanism to keep prices below $10 a gigajoule.
In the medium term, if Australia reserved just 1/3 of its current East Coast gas production, it would be sufficient to meet expected residential and commercial demand, industrial decarbonisation needs, and gas peaking generation to help firm renewables.
Frustration in the manufacturing sector is at boiling point after years of policy interventions have failed to significantly bring down the cost of gas. The industry says the federal government's $12 a gigajoule price cap has instead acted as a price floor, with newer contracts being offered for as much as $20 a gigajoule.
It shouldn't be a controversial proposal to say that in a country like Australia that is awash with gas, that has more than enough gas to supply both domestic customers first, but still have sufficient gas to have a thriving and globally significant export industry.
The gas lobby is on board with a gas reservation policy, but only if applied to new projects. It's also against any form of price controls.
So what we want to see is an enduring framework that actually ensures that we're bringing more supply into the domestic market. That's the key to putting downward pressure on prices in a sustainable way.
I don't think we have a gas supply issue. We have a gas export issue.
But energy experts say bringing on new supply is not the answer to bringing down prices. With estimates of getting gas out of the ground at new fields like Narrabri and the Beetaloo Basin well above $10 a gigajoule.
I think the only way we get gas prices on the East Coast to $10 a gigajoule is through additional LNG supply from Queensland, gas held by the LNG exporters.
Without action, manufacturers say there will be no future made in Australia. A catastrophic mine disaster in remote West Papua has rocked global copper supply chains. A lethal mudslide at the controversial Grasberg mine is forecast to contribute to a massive shortfall of copper. Copper is key to the shift to electrification, and prices have surged to a near record high, as Clint Jasper reports.
A deadly mudslide in the mountains of West Papua has sent shockwaves through the global copper market.
I think the Grasberg incident is probably the most significant of the supply disruptions that we've had this year.
Over 800,000 tonnes of mud fell into the Grasberg block mine, killing 7 workers at the world's second largest copper mine.
It's a big deal in terms of the supply-demand balance, in terms of supply going forward.
The mine's US owner, Freeport-McMahon, is scrambling to recover the bodies of 5 workers and complete lengthy damage assessments. The Grasberg mine has faced controversy over worker safety, environmental impact and governance in the past. Copper is one of the most in-demand metals on the planet right now, an essential element in electrifying the world.
Around the world, the race for copper is intensifying.
A key component of electronics and EVs, last week copper prices on the London Metals Exchange marked their biggest weekly gain in a year, and prices have defied concerns about an industrial slowdown brought on by US tariffs. The Grasberg disaster is the latest in a series of major supply disruptions. This year, flooding at Ivanhoe's Kamoa-Kakula mine in the Democratic Republic of Congo, an accident at Codelco's El Teniente mine in Chile, and protests at Hudbay's Constancia mine in Peru form a list of significant supply disruptions in the copper market. But the loss of production at Grasberg over the next 14 months is estimated to be equivalent to the entire output of the world's third largest copper mine, the Collahuasi mine in Chile. The market has responded accordingly, with copper futures nudging historical highs.
This was probably the biggest shock to the system for copper, which you've seen the copper price already react on the back of it.
These supply setbacks have analysts declaring a deficit in the market and some big trouble coming down the line.
This will absolutely be a problem in 2, 3, 4 years when, if you haven't invested a copper mine now, you're not going to get the supply from that investment in 2 or 3 years, and that's where the problem is really looming.
Analysis by Barrenjoey's estimates the world needs around 1 million tonnes of new copper production each year to meet the growing demand. Over the last 3 years, just 500,000 tonnes per annum have been added to global supply.
These are big projects we're going to need, but the timescales to bring this on and the capital required, we're talking years, like we're talking 2030s before a lot of these projects go up and running.
Here in Australia, mining giant BHP announced it would spend $840 million upgrading Australia's largest copper resource, Olympic Dam.
Today, BHP is the largest producer of copper in the world, and we expect to double our current production by the middle of the next decade.
But better market conditions have also opened the door for mines to restart production. Cyprium Metals recently raised $80 million to reopen the Nifty copper mine in WA's Pilbara.
When the mine went on care and maintenance, the copper prices were between $6,000 and $7,000 US per ton, and today they're between $9,000 and sometimes above $10,000 a ton. So nearly 40 to 50% higher.
It's expected that mine will be producing copper by the middle of next year. But Australia cannot produce enough copper to fill the supply gap in the market.
The scale of them is not enough to solve that issue. So Australia can play a role, but it's I still don't think the projects that I've seen are enough to fix this problem.
Meaning Australian copper can't satisfy the insatiable hunger for copper in a rapidly electrifying world.
To the share market, where it was a lacklustre week in low-volume trade. The ASX 200 and the All Ords ended the trading week down 0.33% each. Lochlan Halloway, market strategist at Morningstar, joined me at the end of trade on Friday. Lochlan, the peace deal in the Middle East has certainly seen oil prices fall as that conflict appears to ease, and the shine has come off gold despite its spectacular run-up.
Exactly. So there's two stories going on there. With gold, it's mostly because investors see this de-escalation of tensions as a generally sort of risk-on move in sentiment. Gold seen as a safe haven asset, so when we see risk-on attitudes, we generally see investors moving out of gold into risky assets. With oil, it's somewhat related, but in oil it's more about the fact that there is now potentially less outlook for supply disruptions in the Middle East, as we take some of that risk off the table there. More supply, lower prices, and on the ASX today, we've seen both gold and oil plays coming off modestly.
The Australian share market has seen a steep run-up since April, even with a slight dip last month. Is there any value left in the market?
So in the main, we see Aussie equities as pretty fully valued. Australian equities have been on a tear in the last couple of years. Since sort of June 2023, Aussie equities up about 30%, which is a very strong total return for an asset class typically goes up sort of 9 or 10%. So 2 very strong years, and what's perhaps a little bit more interesting or concerning is that it's only a handful of stocks that have really driven a lot of that, really just the big 4 banks. Now, we don't see a particularly obvious fundamental reason why those stocks should have run as hard as they have, and that's meant that our market is becoming more skewed towards banks, which means more skewed towards property, which is an asset class investors probably already hold elsewhere. So in the main, the large cap space is expensive to us, but there are plenty of opportunities still in the ASX. You just have to look a bit further down.
So that idea of concentration risk in the banks is kind of similar to the concentration we're seeing in tech in the US.
That's right, though I would probably argue that there's a bit more of a fundamental catalyst for that Mag 7 US tech-heavy concentration. We could argue the toss about whether it's justified and whether these stocks are overvalued, but nonetheless there is still plenty of blue sky potential for AI. Risks of misallocation for sure, but that doesn't mean there's not potential there. So we've got a fundamental driver there. We don't seem to have such an obvious fundamental driver here for, yield, defensive, bellwether bank stocks.
Well, China announced new controls on the export of rare earths, technologies and associated items. What did the rare earths miners do on the Australian share market when that was announced?
So not a lot today, but they have had a very strong week. It's all part of this sort of geopolitical, geostrategic play in the rare earth space. So China controls something like 60% of rare earths supply globally and almost all of global rare earths production. Now, rare earths are very important inputs into defence equipment, electrification equipment, and very important for the Western world in this sort of geostrategic tussle with China. So China is going, or President Xi is going to be meeting with Trump at the end of the month, and it seems like this is the first attempt to get a bit of a leverage, a bit of a bargaining chip ahead of that conversation. Now, what that's meant for rare earth suppliers outside of China is that the investors are looking, well, where can we potentially find supply that's not related to these export controls? So our locally listed rare earth producers have done quite well over the last week or so.
Well, GYG, the fast food Mexican chain, was a really hot retail stock last year. Its earnings numbers were out this week. Were they to investors' tastes?
Look, they were pretty much in line with what the market expected and what we expected. The company's still on track to meet its full year guidance. I think the sell-off in part has something to do with the fact that there's a lot of optimism baked into this stock. Like, yes, GYG, it's an enviable business model. So, you know, you like to be a franchisor because it's almost a royalty-like business. Your franchisees do a lot of the capital investment, and that's great. But it's very early in the GYG journey. They have a long-term ambition of 1,000 stores in Australia and a global expansion. We think it's too early to credit them all of that yet, so we don't see a significant margin of safety there for the share price, and I think some of that deflated a little bit over the last few days, and it was a pretty reasonable result, but just not up to what the market expected.
Lochlan, Halloway, thank you so much.
Thanks.
And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern Daylight Time on the ABC News channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.